Finance is evolving, and Luxembourg stands at the heart of this transformation. Through continued investment in talent, technology, and cutting-edge financial services, the country is helping to shape a smarter, more agile, and more innovative financial industry. As a hub for global expertise, Luxembourg is at the forefront of blockchain and digital assets, providing legal certainty and turning emerging technologies into practical, real-world financial solutions. The decisions made today will define tomorrow's finance.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning, ladies and gentlemen. Welcome to our Focus on Investing digital event. Investing today stands at a fascinating crossroad. We operate in a world marked by market volatility, geopolitical realignments, and accelerating technological change. In such an environment, investors face the challenge of looking beyond short-term fluctuations to identify the structural trends that will define the next wave of investing opportunities. So how are investors recalibrating their portfolios in this era of polycrisis? We'll hear more about this in the minutes to come. Against this backdrop, thematic investings are evolving, particularly through ETF, balancing investors' appetite for targeted exposures with the challenge of delivering sustainable returns. Where do opportunities and risks lie for different types of investors? And what are the key themes that are shaping portfolios construction? A panel of experts will help us better understand all this. As investors reassess portfolio composition, private debt, real assets, and infrastructure are gaining traction. So what are the key drivers for their growth? And should investors rethink their allocation mix? Over the next hour, our distinguished speakers will address all these questions and more. We will start with a keynote address by DWS Group's Chief Investment Officer, followed by a panel discussion on thematic investing. After this, we will conclude today's event with a fireside chat on private debt, real asset, and infrastructure. So without further delay, I am delighted to welcome Mr. Vincenzo Beda, Chief Investment Officer at DWS Group. Vincenzo, the floor is yours.
Thank you, Matthias, and a warm welcome also from me. I'm Vincenzo Beda at DWS Group, and it's a pleasure to be speaking here today about the markets. And to be fair, I have 10 minutes, so I'll try my best to get at least the core kind of decision points that we currently hear from our clients into the next 10 minutes. So let me start by giving you a scenario. If I would have told you 5 years ago that we're going to have a pandemic that's going to shut down most of the economy. We're going to have 2 wars. We're going to have a real estate crisis in China. We're going to have a commercial real estate crisis in the US. We are going to have a regional bank crisis. And now we have tariffs in the US, which grew 6 to 7-fold. I'm not sure how you would look at it, but I probably think you would have sent me out of the room if I have told you that in the same time, equity markets would almost double. And that's kind of where we are today. So a lot of the questions I get, have we gone too far? Is this a bubble? What's the economy going to do here? As I said earlier, with tariffs this high. So maybe let's start with the macro environment. And I've already mentioned tariffs. Tariffs kind of has changed the way we look at the global economy. And if there's one theme at the moment, it's the theme of convergence. We think growth between Europe and specifically the US is going to converge more, but also between the rest of the world and the US is going to converge. Why is that? As I said earlier, we believe that tariffs on US imports are going to grow from about 2.5% pre-Liberation Day to, we think, going to end up at about 14% on US imports by this year. So this is a major increase in tariffs, and therefore it will have effect on global growth. We believe it will disproportionately hit US growth, and therefore it's going to slow down over the next 18 months and then recoup to what we think is potential growth of slightly below 2%. In Europe, similarly, we will have some hit from tariffs, but ultimately we believe that given the increased fiscal spending of Germany, that actually the European economy will actually grow a bit more than we have seen in the last few years through this fiscal impulse. So overall, it's a convergence of growth rates between Europe and the US. In fact, we expect GDP growth of 25 in Europe to be about 1.3%, while in the US we expect about 1.5%, and in 2026 we expect 1.1% growth in Europe, while 1.3% in the United States. Inflation will remain above the 2% in the US, while actually being right on target in Europe. So what does this mean? It means that the Fed will continue to cut. Our expectation is that by the end of September, the Fed will cut 4 times to a rate of 3%. And at the end of November, actually, we're going to give you a full year forecast on that. We also think that the ECB is in for one more cut because we believe that the fiscal impulse will take time to come in. And in the meantime, the ECB will take the opportunity to cut one more time. So the backdrop is actually falling central bank rates and therefore a stimulus to the economy from here onwards. So let's move on to the question, well, are we in a bubble? That's probably the biggest question I've been hearing from most of my clients in the last few weeks and months. And I can tell you I've been traveling quite substantially to see clients in the US and also in Asia. And let me tell you our short answer. We believe we are expensive and undeniably there are risks, but we don't believe that we're in a bubble. And just a few points to make this point. One, generally in bubbles, we have seen even higher valuations. So you could argue, I'm rationally predicting more irrationality before we come into a bubble. Secondly, if you look at the market structure, it has changed quite a bit. 35% of US equity trading volumes these days come from retail. We have continued buybacks from US companies at a very high level. And then thirdly, we believe that most institutional clients are still on the sidelines. If you look at some of the holdings on hedge funds and also some of the long onlys, we do not think that everyone is fully bought into this rally. So this will give us actually the backdrop of potentially further growth. The last point I would like to make is that this rally has been earnings driven. That is very different from the internet bubble. A lot of this growth has been through earnings growth. So there is a real backbone behind it. If you look at the Mag 7s, most of them have an amazing business model. They're really strong and have double-digit earnings growth, not through AI, but through their actually initial business models. So AI is almost a free cash flow investment on top of it. And we don't think that in the next 6 to 12 months, all things being equal, that this narrative will actually be challenged. So we think that into the next few months, tactically, we remain very positive, assuming, and that's what the earnings season that is happening at the moment will show, that earnings continue to be delivered, which again is our base case. So overall, we remain very constructive. Having said that, we believe that there's a high concentration into the US. The US by now is a very concentrated market with the top 10 stocks of about 35% of the index. And we believe there's pockets of good beta, there's pockets of good alpha elsewhere. And just to name a few, we like Europe. Europe is actually a market that is driven by value. European domestic companies have done really, really well. If you think about European banks, it's the only sector in the last 3 years that had a better performance than actually the Magnificent Seven. So overall, Europe has different types of opportunities. The last opportunity we like a lot is European small and mid caps. European small and mid caps actually have outperformed their large cap peers. That is very different to the US, which is driven by mega caps. We also think that you also should diversify not just within equities, but surely across asset classes. So if we look at what's happening on the yield side, we come from a time where there was little yield. We just heard we think that the ECB and the Fed are going to cut rates. That means that historically, the belly of the curve, around 3 to 5 years maturity, have done really, really well as the curve is normalizing and getting steeper. So we like these type of maturities. We still like investment grade bonds. These days, they seem to be safer than many state or government bond issuers. So generally speaking, the large companies are in very good shape, very strong balance sheets. And while spreads are very, very tight, the all-in yields still are very attractive. And we would suggest to ensure that a well-balanced portfolio has enough exposure to these type of things. So last but not least, one topic that I've been discussing a lot is gold. Gold has had a phenomenal rally with about 50% of return. Again, here the question is it gone too far? Is it too expensive? And generally speaking, we think that gold has quite done an incredible rally, and so we would be a bit more cautious, but we remain constructive on gold. And for the one reason that gold is the only real diversifier in a portfolio at the moment. Last Friday, when we had Trump's announcement on additional China tariffs, you could actually see that gold did exactly as expected and that was diversify away from risky assets. So this is the role we would give gold in any diversified and balanced portfolio. So remain constructive in gold and do not think that it's time to sell right now, especially as we think that central banks will continue their buying. And we just had initial institutional clients and retail clients adding gold to their portfolios. So overall, we believe that the next few months will be very constructive, but also that we need to stay very, very vigilant, and that we therefore need a really broad, diversified global portfolio to manage the volatility and the ups and downs that we're going to see. We think that the AI trade is going to continue to run for now. I think we should definitely look out for it in the next 6 to 9 months. And we believe that while credit spreads are tight, especially the highly rated side of the market is still very attractive. We would be careful in high yield, where I think real picking is going to be extremely important. And with that, thank you for your time. Thank you for listening in. And I want to hand over to Hind. Have a great day.
Thank you, Vincenzo, for the introduction and for passing the floor. Good morning, everyone. My name is Hind El Gaidi. I'm LPA president and also head of Luxembourg at ICG, and I'm delighted to moderate today's panel. And today is about a discussion on how thematic strategies are evolving in the current investment landscape. I'm joined today by 3 experts: Mr. Luigi Antonacci, head of equity at Eurozone Capital; Mr. Michael Seward, head of ETF equity markets and strategies at Amundi Asset Management, joining us from Frankfurt today; and Mr. Omar Mufti, EMEA head of sector, themes and commodities at iShares BlackRock, joining us from Zurich. Gentlemen, welcome. Before we dive into the conversation, let me set the stage with some context. So we're witnessing a remarkable transformation in the ETF landscape. the industry had experienced record-breaking growth, with global ETF assets surpassing 12 trillion in 2024. This is a trajectory that shows no signs of slowing at the moment. And three trends have been standing out to us. So first, the explosive rise of active ETFs. What was once a niche segment now represents one of the fastest growing areas in asset management. Active ETFs are bridging the gap between traditional active management and the accessibility of ETF structures, offering investors alpha potential with the transparency and the liquidity they've come to expect. Second, thematic investing has moved from peripheral to mainstream. So themes like AI, cybersecurity, clean energy, etc., maybe also defense, are capturing significant investor attention nowadays. And also capital flows. So AI-focused ETFs alone have attracted tens of billions in new assets over the past 18 months, reflecting both technological disruption and investor conviction. And third, not the least one, is the democratization of sophisticated strategies. And what institutional investors accessed through bespoke mandates is now available to retail and wealth management, and through thematic ETFs, obviously. So that's lowering the barriers and reshaping the portfolio construction across all the segments. And the question today is not whether thematic strategies are relevant, but how they're evolving. And that's why we're gathering today on this panel. And also understanding where the opportunities and the risks lie for different investor categories. So let's explore this together. And I'll start with you, Michael, to walk us through the main drivers of adoption from retail investors' perspective.
Yeah, perfect. Well, thanks, and thanks very much for hosting this panel. I think it's a fantastic kind of venue for this discussion. And retail adoption is a very big topic, but I will summarize things as best I can. And I think there are really three main drivers which are really driving this kind of tsunami wave of retail adoption that we are seeing now spreading across Europe. And these are broadly a reduction in friction in accessing investment strategies. You mentioned this already. Some product innovation coming from issuers across the spectrum. And also, I think, an increase in financial education, which is driving that evolution from kind of a savings culture to more of an investment culture, which I think is fantastic to see. So those are the three that I'll kind of focus on. Now, of course, ETFs, focusing first on the reduction in friction. ETFs really have existed for decades now, as that being one of their key goals, which is to democratize, to reduce frictions, and be widely accessible and broadly diversified when it comes to offering investment strategies. And now, for decades, we know that professional investors have made use of the ETF wrapper for asset allocation decisions, for risk management, for diversification, as I say. And really, you can think of the ETFs as very much being almost an operating system that investment allocations were being built upon, because as a wrapper, it provides so much flexibility and transparency as well. But there's been a key ingredient that's been missing here, and that's been the reduction in friction when it comes from retail investors actually accessing ETFs and accessing markets more broadly. And historically, of course, this was done in a bit of a clunky way. But now, with the rise of digital wealth, we've seen a fundamental change in how retail investors are able to access markets. Obviously, much more efficiently, much more easily, using things like smartphones or other devices. But I think importantly, we've also seen the reduction in cost, the reduction in minimums required. So investors can put aside just a few €100 a month, for example, into a savings plan and have that invested as they see fit. And these have really been game changers when it comes to reducing some of the frictions that have really caused historical lags between institutional and retail adoption. So it's great to see these coming down, absolutely. And of course, this reduction hasn't gone unnoticed. So issuers across the spectrum have invested in product innovation and really have launched products ideally targeted for the retail audience. And you've seen this across the board over the last few years. One key theme, for example, would be these widely diversified kind of all-in-one equity solutions that we've seen from a number of providers, which allow retail investors to allocate to the global market of equities with just a single trade or a single line in their account, which has been very compelling for retail investors. And we've seen a lot of flows into that space, a lot of interest for those types of products as investors kind of build their core around these types of offerings. So product innovation, of course, is one. I mentioned reduction in friction, but the last thing here has really been investor education. And this is an incredibly important area, and one where I think we can all, as an industry, do a bit more. But certainly we've seen a huge uptick in kind of financial literacy, the interest that retail investors are taking in investing and learning about building portfolios. And as an example here, Amundi do a survey of around 11,000 retail investors across 25 countries. And the insights that we get from this survey are fantastic. They're really, really interesting. And one of the key things I would point out is after low cost, which I think is always going to be a high priority for retail investors, the next top 3 topics when retail investors were asked, what would you like to see most from your platform, were actually not just low cost, but actually more data, more historical data, and easier ways to compare and contrast performance across products. So these investors are hungry for more data. They're hungry for the platforms that they use to be providing them more. I think that's a fantastic thing. I think as these platforms continue to evolve and the data improves, this will only help to further reduce that uncertainty or that mystery around building portfolios that can sometimes be the case for a retail audience. So those would be the 3 that I would summarize.
Thank you. I'm curious now, Omar, do you echo this message for wealth management clients, or is the landscape different from your perspective?
Thanks, and super excited to be here. Well, I think definitely everything that Michael said is absolutely valid, and there are other elements, but I'll echo Michael definitely with a 3-point plan here. So I would say there's probably 3 key trends that are driving that continued thematic adoption on the wealth side. First, end client demand. So we're in a world of very rapid and often drastic change, and clients are seeing that in their day-to-day lives. And it's reasonable for them to expect to see this change being reflected in their portfolio. So that's definitely the first element there. The second, more focusing on those wealth managers directly, is portfolio differentiation. And this is a question of alpha, the traditional metric, but it is also a purely business consideration as well. In a world where beta has become so easily accessible, and by beta I mean traditional regional beta via trading platforms, it's increasingly important for wealth and asset managers to demonstrate the value proposition, to differentiate their portfolios, and be taking express views in them. And yes, that is possibly more difficult than the traditional regional building block approach of overweight, underweight, but that is exactly part of the value propositions that investors expect. And managing those opportunities and the risks of on a portfolio level is really what PMs can focus on. And so end client demand, portfolio diversification, differentiation as the second point, and maybe the third is a shift in investment processes. That traditional approach of doing regional macro analysis into micro implementation simply works less well in a world where company fundamentals no longer reflect the fundamentals of their domicile of a specific region. Most companies, or especially the larger ones, are global in nature and are accessing mega forces, huge structural trends that are driving the world and the economy, the world in which they live, consumption patterns, and ultimately their earnings. So mega force investing, that taking that long-term lens and expressing them via thematics, offers an alternative to that traditional macro to micro lens. So the landscape is clearly evolving. Wealth managers are definitely at the forefront of that evolution. And as you said, Hind, we're seeing not just tactical plays on thematics, but a progressive shift towards the core. And all of this helps advisors and PMs tell a compelling story and one that resonates with the end client.
And we'll get to that in a minute. But before we go there, maybe ask Luigi to bring us home with what about institutional investors? Do you see the same play?
Thank you, Hind. Yes, let me start from some points made earlier about the contribution of the retail segment into the growth of the ETFs. Certainly, the retail investors have strongly contributed to the success of the ETFs right now. However, the growth of the ETFs has been also strongly supported by institutional investors who are increasingly demanding for more flexible vehicles in their asset allocation. And in my opinion, this behavior has been amplified by the current market environment, where risk appetite and prudence are evolving in parallel, driving investors in looking for new strategies in order to add diversification to their portfolios. And at the same time, they are looking for more flexible investment vehicles in order to add more flexibility to their portfolio. Indeed, looking at some financial market patterns year to date, we find a somewhat contradictory situation. Indeed, we have equity indices that are up and very close to their historical records, with some episodes of volatility, of course. And at the same time, we have gold that has risen to its all-time highs and keeps rising. This positive correlation between equity indices and gold is something not so normal in the financial market. It's not something we often see historically. However, it's telling us something important about the current investors' psychology. Because investors, institutional investors in particular, wanted to take on risk, wanted to participate in the rally of risk assets, but they want to do so cautiously. And for these reasons, many institutional investors are seeking more flexible investment vehicles such as ETFs in order to be ready eventually to change their allocation if the market conditions change. And my perception is the institutional investors are not replacing a mutual fund with ETF. Rather, they are complementing their mutual fund holdings with ETFs in the position. However, the mutual fund remain a cornerstone in the professionally managed portfolio because still address many of long-term investors' needs. However, when it comes to more tactical purposes, investors need some instruments that are more flexible, more transparent, easily accessible, that can be traded during the day. And that's the reason why they are looking for adding ETFs in their positioning in order to be eventually ready to act if there are new market developments. So this is for sure a new behavior that we have to take into consideration. And this is the other part of the story alongside the retail segment in explaining the strong success of the ETFs we are witnessing in recent times with the asset under management level being surpassed year after year.
Thank you for sharing, Luigi. And I can say that across the board, maybe for all the investor categories, we can see that there is a heightened need for flexibility. But then looking across investor segments, that there are some who will be looking more at the costs and the accessibility, for instance, for retail, or the customization for the wealth clients, and rather more strategic allocation for institutional investors, and that's what they're known for, right? So now let's turn to the themes themselves and the what's behind the flows, maybe. And Omar, so I get back to you, as I mentioned earlier, let me start with you on the AI in particular, that has dominated the headlines and investor conversations. From your vantage point at BlackRock, what are the key trends shaping investments in AI and other emerging technologies? And maybe more importantly, what is the investor appetite in relation to this sector? Do you see that there is sustained market adoption, or do you believe there is a little bit more speculative froth going on?
That's a great question, Hind. So first, I think some context. If you look back at how eras are defined, they're often very closely linked to new technologies. I mean, we can go decade by decade, but the 80s, personal computing, 90s, the internet, 2000s, you could say smartphones, 2010s, cloud computing. Technology clearly shapes that age. And in our view, AI is likely to be that defining technological advancement of the current decade. It is at that convergence of technological capability, corporate investment, and consumer adoption, and that's driving real economic impact. It's had a notable contribution to, say, US GDP growth in the last few quarters. And again, this needs to be reflected in portfolios. Now, in our mid-year thematic outlook, our first section was called Underestimated AI Momentum, in as much as we felt the market was failing to recognize or maybe realize the scale of AI infrastructure investment. Since that outlook in July, I think markets have been jolted awake by strong earnings, good guidance by AI infrastructure companies. But still today, I don't see broad-based froth, rather perhaps the risk of selective short-term overvaluation, but no more. And one indicator, incidentally, a soft indicator that gives me comfort in that view is the amount of discussion I have about the bubble risk, which tends to indicate that there is a wall of worry that these stocks can still climb. Now, with that said, AI flows have been sustained, both retail and institutional, or more on the institutional side. And importantly, many have held through the volatility. For me, that suggests conviction as opposed to speculation. But an interesting progressive trend that we're seeing is a broadening out of the expression of AI. AI is more than just these mega cap AI infrastructure name, more than the semiconductors, cloud, and hyperscalers. So increasingly, investors are looking downstream, so moving from AI infrastructure into AI adopters, to robotics, to cybersecurity, even water and copper that are very intensively used in AI data centers, or interestingly looking for AI with cheaper valuations, such as China tech. That's gone under the radar, but it's a theme that's seen some $3 billion worth of flows year to date. So completely segmented AI ecosystem. So suffice to say, we are structural bulls on the AI theme and feel that AI has become a transversal technology, and investors are very well attuned to the various opportunities that AI opens, and there will always be a very attractive AI-linked opportunity in the market. It doesn't simply have to be in those mega cap AI infrastructure names.
Thank you for sharing. It's very helpful to decipher the FT weekend headlines. Thank you, Omar. And maybe now let's pivot to you, Michael, to a theme that's perhaps a little bit more controversial, and you'll help us decipher that one. It's defense, which is also equally compelling, right? Looking at the geopolitical tensions, the increased military spending across Europe and beyond, these are reshaping investment narratives. So what are you seeing in terms of growth and investor interest in defense-related themes? And how is investor sentiment evolving with that regard? And the question that is maybe interesting also to answer is whether you see that these are tactical allocations or rather a more systemic shift.
Yeah, no, absolutely. So yeah, you mentioned FT headlines. I mean, I think between defense and AI, you've captured a broad percentage of AI headlines, or sorry, FT headlines this year. I think it's been a hugely topical story. And I think the thing you mentioned at the start of your question there, Hind, which is a potentially controversial topic. I mean, this is even in itself such an interesting point that really has evolved over recent years. I think if we were having this conversation, perhaps even 3 or 4 years ago, yes, defense would be, I think, seen as a topic that was perhaps not in the same light as the current kind of ESG thinking back in those days. But actually what we've seen is a tremendous mind shift in investors around the necessities of defense, whether that's kind of from a strategic autonomy point of view, or the sense of kind of a European defending, Europe defending itself. I mean, these kind of topics really have evolved. And so what we're seeing now more and more are ESG investors who may have previously had different views on the defense sector, perhaps evolving those views, taking a bit slightly more nuanced opinion about defense. So I think that's an interesting point here on its own. But honestly, there are so many things to speak about when we think about the defense sector, the interest that we've seen from almost a standing start, almost zero assets in defense-focused strategies just about a year and a half or so ago, to now over 10 billion in flows across UCITS ETFs. And what's been remarkable is that the kind of subset of that, which is really focused on European defense, has really taken off very quickly. And so of that 10 billion, about 4 billion is in Europe-focused defense strategies. And again, this is from almost a standing start of zero not too long ago. So it's been really tremendous interest in this topic. And of course, investors have seen the headlines, they've seen the commitments from NATO around minimum spending requirements and kind of the targets that have been set around 3.5% or even 5% in some cases. And those topics, those targets, they translate into real dollar commitments, right? And some of the figures that we're seeing here are remarkable. It's kind of at a par with some of the figures you see in AI from a CapEx perspective. These numbers just kind of boggle the mind. But ultimately, from a defense perspective, we're seeing these long-term commitments from countries. And this is really translated into investors, looking at this allocation, I think in a very different way. So you've mentioned the question, is this tactical? Is this strategic? And of course, we speak to many different types of investors. So the answer would be it's both. In some instances, there's been tremendous performance this year from defense stocks. And so we, of course, see some investors playing that allocation more tactically. But speaking to investors as we do, I think we get a lot of feedback around planning for the next 5, 10 years when it comes from a portfolio allocation perspective and looking over that level of time horizon. And certainly when you look at defense and kind of the commitments that are being made, I'm coming to you from Frankfurt today in Germany. We've just had over recent weeks this German fiscal impulse that's been approved through the government, which is really going to put the onus on defense spending, infrastructure spending. These are topics that will play out over multiple years. And when it comes to a theme or a sector like defense, the firms in these categories can really benefit from that over the long term. And there are additional catalysts too when it comes to things like export markets and the ability for these firms to really scale and drive margin improvement and margin expansion. So there are a lot of areas around this topic, as you can imagine. But certainly it's one, as I say, just to kind of focus specifically on your question, it'll be around these kind of strategic allocations and ability for investors to really position themselves for the long term in this market. And so that's something that we're seeing and something that we're kind of seeing play out now over multiple months. And we expect that to continue over the next few years as well.
Well, thank you for sharing the non-sanitized version, Michael. and Luigi, maybe we want to bring it now back to the vehicle itself, the ETF, right? And for years, the ETFs were synonymous with passive and index tracking strategies, but clearly we've seen a shift. And do you see that also expanding into new strategies, or how do you see that evolving in terms of investment segments underlying the ETFs?
The growth of the ETFs has been broad-based, no doubt about that. However, I know there are many investors still tend to think ETFs are solely intended for passive management or for index replication. However, numbers are telling us something completely different, because the share of ETFs included in the institutional investors' portfolios has risen significantly in recent times. Across the board, regardless of the market segment we look at, be it passive, active, innovative strategies, thematic strategies, even sustainable investments. And a further confirmation of the positive trend of ETFs may be seen when looking at the sustainable investment segment. Indeed, this segment has grown significantly in recent times. The total asset management of the sustainable investment, all the funds, not only ETFs, under Article 8 and Article 9 of SFDR, reached the remarkable level of 9 trillion euro. And of this total, 450 billion is invested through Article 8 ETF, up roughly 100 billion in 2024 alone. So this means that even when it comes to sustainable investment, for the investors it's not only a matter of what investing in, but it's only a matter of how access the market. And regardless of the market segment, now the investors, retail investors, but in particular institutional investors, are looking for more flexibility. And this is confirmed by the behavior of the institutional investors. And in this regard, our discussion so far made me think about another point I would like to bring to the table. The role played by all the ETFs, regardless of the market segment, is playing in enhancing the market efficiency. By definition, ETFs are more accessible, are transparent, well-regulated, but at the same time they are liquid, they are tradable, they are easily accessible for all the investors. So this means that the investors normally use ETFs to recalibrate their allocation in order to incorporate the new information as soon as it becomes available on the market. It's obvious that this speed in reaction may create some spikes in volatility sometimes. However, I wouldn't define that as a pure financial speculation as some observers do. Rather, a side effect of the greater efficiency the ETFs bring to the market.
Excellent insights, Luigi. Thank you for sharing that. We haven't picked on that last time, right? We've covered a lot of ground today on the drivers, the themes, and also the evolution of the vehicle itself. Now let's look forward. The investment landscape is shifting rapidly. Reg changes, tech disruptions, macro uncertainty, and evolving client demand in all segments. So what I'd like to ask each one of you is, what are your key focus areas over the next 18 months? And where should investors be paying attention? So maybe let's start with you, Luigi.
The backdrop remains supportive for the growth in the long term of the ETFs, no doubt about that. And in my opinion, even the current environment is conducive to the growth of the ETFs in the medium term, but even the short term. Macro picture remains resilient. Growth has been stable right now. The inflation is converging. Corporate earnings are holding up very well. However, beneath this surface stability, there are still some sources of uncertainty that may create some spikes into volatility, in particular coming from geopolitical fragmentation, rising political and international tensions. So in this landscape where volatility is under the corner, I think that the institutional investors will continue to demand for more flexible investment vehicles. And in my opinion, they will continue to ask at the same time for having a new strategy, new investment strategies. So there are two forms of innovation. The innovation of the what, investing in, thematic strategies, and the innovation of the how, access to the market. And in my opinion, these two dimensions of innovation are moving together in reshaping the financial landscape and driving the future of the asset management. So in this context, where we have a positive sentiment on one side and a persistent uncertainty on the other side, it's very hard to imagine that the structural growth of the ETFs may slow down anytime soon.
Michael, what's your take on that?
Yeah, it's a great answer from Luigi. I think I would agree with a lot of points, but rather than go over them again, perhaps I would add a few more as well. I think would be quite interesting. So of course, the innovation theme came through strong from that answer from Luigi, which we would expect to see, of course, continued and ever more rapid innovation when it comes to product designs and offerings, and even increased personalization in many ways of outcome-oriented strategies. I think this has been a theme that has been, picking up, pace and interest over recent years, which is things like income strategies, for example, for investors who have reached the stage where they want to start drawing more income from their investments, more outcome-oriented strategies, using more complex structures in many ways, but having simple outcomes around defined outcome or defined income strategies. So this more broadening of the investor toolkit for retail investors is only going to continue. I think that's a fantastic thing for continued adoption, as Luigi mentioned, in this kind of structural growth that we are seeing in the ETF wrapper. So that's definitely one area. But of course, I'll come back to education as well. I think this is such an important area that all ETF issuers and all kind of asset managers, need to take that responsibility around education. I think this is a fantastic thing that we're seeing a lot of this happen already. But ultimately, there are still areas where I think we can do a lot more, and then certainly around structuring of products. I mentioned some of those popular large products that are available today for retail are often physically replicated. Are there opportunities for other types of replication to enhance performance and outcomes? And we've seen swap-backed ETFs be very popular amongst more institutional, perhaps, and wealth clients. So perhaps this is one area that you might see more interest in and more education. But broadly, I think that acceleration is only going to continue as the number of digital platforms, the quality of those platforms continues to improve. So for us, I think this is a very exciting time to be a player in the ETF industry in Europe, as we're seeing this rapid growth in retail, which is really redefining a lot of different areas across the market, as you've heard from Omar and Luigi today as well.
So Omar, let's come a full circle. Can you share with us what's to think forward in terms of investor and the backdrop that is out there for ETFs?
Super. Maybe I'll start with my focus over the next 18 months, and that should lead hopefully to what maybe investors could be looking at. So definitely echoing what Luigi and Michael said about that innovation side. I think what's super interesting about this segment is that evolution breeds more evolution, disruption breeds more disruptions. So AI likely to remain dominant, but that opens up rising interest and need in adjacent areas, whether it is quantum computing, whether it's nuclear. All of these become more viable and become opportunities, and we expect to see growing interest here in what are still early stage technologies. So continued evolution of the space and of the strategies. I think the second aspect is portfolio integration. You said it, Hind, that move from tactical plays to more strategic allocations. That means more demand for multi-theme solutions and risk frameworks that help clients to align with broader portfolio goals. So helping clients to understand their mega force tilts. In Europe, most investors are overweight, low carbon transition and maybe underweight AI. So helping understand how these roll up at a portfolio level, and then also how to blend this with core and with factor strategies, for instance. And the third area of focus for me, which is beyond the evolution and portfolio integration, is thematic fundamentals. And that means, moving beyond that narrative focus that many investors still think thematics are. This is about real world fundamentals and thinking differently about investments. And to be fair, it is also about helping investors navigate cycles. Many investors have been burnt by strong narrative not being reflected in the fundamentals. So helping navigate that. And with that view, our focus is, we still like AI, but acknowledge what you mentioned in your question, in that the valuations are no longer cheap in our view, but they are fairly valued. There are other opportunities. We think the mining segment as a whole is attractively valued, and we're seeing that the supply crunch over the last decade being reflected in prices. So that may be an opportunity, but more interestingly perhaps is diversifying strategies, trying to find alternative return access, whether that's via digital assets or via low volatility thematic strategies. I think there are a lot of opportunities in this space.
Well, thank you, Omar, Michael, and Luigi. This has been a very rich and insightful discussion. And maybe let's just summarize the key takeaways. One is that thematic investing is no longer a niche strategy. So it's now become a core component of modern portfolio construction, right? And also taking into account what we see in terms of trends and underpinning markets. And we've discussed that at length earlier. Second, what I've had noted is that the themes capturing capital today, as in AI or defense or clean energy, but also we heard mining, they reflect both structural megatrends and also shorter-term geopolitical economic catalysts. So it's that blend that's brings together and comes together in those, let's say, headline sectors and segments where we see investing. And that the challenge for investors, as I understand it, is that being able to distinguish between what are durable opportunities and what are hype cycles in a way. And then third is the ETF itself. You said it's enough, I would say, Luigi, is the wrapper itself is evolving. It's coming with innovation, it's coming with flexibility, it's coming with less costs as well. And it's not only about passive beta, but it's more about understanding the fundamentals of that wrapper itself, of the vehicle, and being able to reshape it and adjust it to the needs of the investors. And also there is an aspect of transparency, I assume, and it looks like that's an element that's where all the investor categories or segments come together. Having a vehicle which is cost efficient, which is transparent, and that is also flexible. And finally, I understand that for the 18 next months, you will be critical, as we see that there will be developments, obviously, that are regulatory, that we all are knowledgeable about, but also there are areas as in volatility or development in technology and breakthroughs that will create some shifts in investor sentiments in a way. And that it will be important and essential to be informed, but also to be able to find out what are the secular trends underpinning the news that is in the media. So again, thank you to our panelists and for sharing their expertise. It has been very fruitful. And now I will hand over to Corinne Lamèche, Deputy CEO of ALFI, for the fireside chat on private debt, real estate, and infrastructure investments. Corinne, over to you.
Thank you, Hind. Good morning, Doug. How are you today?
Yeah, I'm very well, thank you very much. Good to talk with you.
So I'm super pleased that I will interview Doug today on private assets, but in particular private debt. So let me start by giving you a short macro overview over the private debt market. So I guess it's fair to say that it has been a fascinating few years for private markets. Private capital has literally exploded over the two last decades, led by obviously private equity, but definitely private debt, real estate, and infrastructure have now a much bigger share in the private asset space as well. After peaking in 2021, flows have obviously cooled down slightly since, but the baseline activity remain above pre-2015 activities. Assets under management globally stand now at 18.7 trillion end of 2024, and the projections are that private markets or private capital will exceed 24 trillion by 2030. So what we can say globally is that private equity remains the largest engine of growth, but private credit is the fastest growing segment. And infrastructure has started small and has now doubled in size. So let's have a quick look at real estate first. So real estate has had a few very, let's say, slower years. But we are now seeing that money is being put into more opportunistic real estate strategies. And that is mainly because, obviously, we know that we need more redevelopment opportunities. And we also see that means that the risk take-on is also back on for real estate managers or investors. So infrastructure, it's very clear that has gone from niche to a core pillar of private markets. In the infrastructure space, we are seeing larger and more complex transactions in renewable, transport, and also digital infrastructure, like data centers and fiber networks. Defense investments will also continue to play a big role given the geopolitical environment. If we now look to private debt, and we're going to come into more detail on this. Yes. So private debt, let's be honest, a decade ago, banks were behind almost every major loan. Now, private credit players have taken over close to 90% of the middle market lending space. So this is definitely a seismic shift. And if we look to Luxembourg, this trend is also visible in Luxembourg. We see that private equity, private debt, and real estate are increasing as the fastest growing increasing classes year by year. And if we just look at private equities, they have increased by 24%, private debt by almost 25%, and real estate still an increase, 13%. So in Luxembourg, we definitely now have a situation where 1/3 of the assets under management are of our 7.6 trillion is nowadays in alternative investments. So, and as I mentioned, it's the fastest growing asset class, whereas before usage was our fastest growing industry. So that already leaves me to start our discussion, Doug, because I just mentioned that private debt is has been over the last few years the fastest growing asset class in the private markets. So how do you explain this trend?
Well, it's a response to what we've seen as far as the European economy modernizing and expanding in its own right. You've mentioned tech and infrastructure and all of the changing and progressive economic stances that the EU has implemented across Europe. You've got a generational change in the Mittelstand, this handover of family businesses to something new. And that's where private equity has been able to become very active and a primary driver in the modernization of the SME space within Europe. And once a private equity company is involved or generally involved, financing needs to be available to take the next step to bring these businesses forward so they can address the opportunities in front of them. The banks, as you mentioned, have been very active in this space, but if you go back 10 to 15 years ago to the great financial crisis, they were guilty of being over-levered. And Basel II and regulations have constrained their leverage, and their appetite thus is much lower in terms of financing small to medium-sized businesses unless there's other opportunities for them. And frankly, small to medium-sized businesses don't provide other opportunities for the banks to find that lending activity attractive. So that's where private debt has stepped into that space. As Europe has expanded, so has private debt as an asset class.
That's indeed, I have to say, that's really what we're seeing also in Luxembourg. But I think that in Europe, we are also seeing that there have been a framework which has been built to even enhance this further. In Europe, we have now we are all talking about the SIU, the Saving and Investment Union. Before it was called SMU, but it's very clear that European policymakers want to finance. We have huge financing needs, and we want to finance a triple transition into more sustainable world, digitalization, and also defense is nowadays a big topic. So this framework, SIU, is looking at means on how to increase saver spending or savings to be transformed into fruitful capital. So in Europe, we know that more than 40% of the savings are sitting in cash accounts. And so now the European Commission is thinking about a program of work on activities about how we can get those savings into capital markets. So, Doug, so how can the SIU support the European business growth in your view?
Well, earlier we were discussing a quote by one of our peers in terms of European self-reliance, right? And Europe, compared to the US in terms of the depth of its capital markets, is far behind. So part of the SIU is to modernize the capital markets and take the savings pool that the Europeans have out of the banks and try to put that into pensions and insurance companies to bring that capital forward to address the self-reliance needs of Europe overall. Now, our biggest, partners in investments, or LPs, are the pension funds and insurance companies across Europe, but also across the world, because it's a global problem in terms of addressing pension savings and longevity, but also the investment opportunities in front of us. So pension funds, from a European context, they want to have longer term assets, right? Because they have pension obligations. That matches some of the funding requirements for business SMEs as they expand, infrastructure as you were mentioning, and even some of the big tech projects, AIs and things like that, which need a longer term financing. So that's where private debt comes into the fact, to be able to lend longer term. We also have a higher yielding product as a result, which is attractive to the pension funds for their own capital return that they owe their investors, right? We have a lower risk, we have lower volatility, a short duration product, and we're able to yield somewhere between 250 and 600 basis points over the risk-free rate, which is attractive for those institutions that need to return that capital.
Yes, and I think there's lots of good things, as you say, going on there, but usually when there's big success, asset growth, the regulators also start to look into it more carefully. And so we are now seeing increased focus of our regulators in Europe and also globally on this, let's say, growing private market asset classes. And so in particular, they are saying we need to look into valuations, transparency, reporting. And in relation to private debt in particular, they're starting to obviously say, well, those private debt funds are acting like banks, but they're not regulated by banks. So Doug, is your business a bank?
No, my business is not a bank. We welcome regulation. We are an asset manager. We have first and foremost a fiduciary duty to our investors to return the capital and achieve the target returns that we're promising our investors. So that's our primary responsibility. Of course we work in a regulated market, but we're not a bank. I do not take retail funds, right? I have institutional investors. The state, no state across Europe offers me any guarantee against the investments that my institutional investors give me, so I don't have that deposit guarantee. The leverage that we deploy is capped. It's capped both in the fund documentation that we have and also in current regulation coming out. So, I'm not a systemically important participant in the marketplace, and we don't trade. So as a result, we're not a participant in the market that's going to be volatile. We want to be long-term stable money. We have very strict loan covenants, which provides additional comfort to our investors, but also additional stability. We basically want to be seen as responsible participants in the Savings and Investment Union, which we were talking about before. We want to be seen to exercise our fiduciary duty, and we want to show that we can achieve the target returns that we promise our investors.
Thank you, Doug. Let's now talk about another hot topic in the private markets. So retail investors, what about those? Obviously, historically, they were shut out of private markets because of regulations, the high entry tickets, and the liquidity issues. But now we are seeing more and more retail participation in private markets, and we are seeing the launch of evergreen funds. And so this is definitely a very big trend, and we are expecting assets under management in evergreen private market funds to double for sure in the next few years. And obviously there has been in Europe some regulatory enhancements as also to support this, or to, let's say, to put a framework so that retail investors are still protected. So how do you see this trend in your business?
So democratization is a key topic of discussion. we recognize that our investor base will start to change from strictly institutional to more, let's say, high net worth individuals. The barrier to entry will be decreasing. One of the challenges that we have is that traditionally when one says retail, one also says liquidity. Now, I have an illiquid asset class, and there is a challenge to be able to provide an illiquid asset to a body of investors that wants to have liquidity. So that's demanding things like the LTIF2 to be created, or the UCITS Part 2, addressing some of those constraints that I need to operate under in order to invite the retail investor into my fund universe, shall I say, right? We identify that the access or the demand for access to alternatives is partially driven by the yields that we're offering our institutional investors. That won't stop. Our yield returns to our investors is kind of a given, and that's a target that we want to do. But we're still in the very much early days in regards to product design to address some of the liquidity concerns. And at the same time, we do think that things like the evergreens is the institutional response to that, where they can lower some of their costs in terms of recreating new funds to just have an evergreen structure so that their returns to their investors is actually higher.
And this is a good example, what you were just talking about, also about the framework, the LTIF you were saying. Definitely, I think this is an area where we can see that regulation sometimes can help to better regulation, because there was an LTIF1, now we have an LTIF2, but LTIF2 is definitely much more adjusted to our players, to our market players, and definitely we have seen a big increase in LTIFs. Yes. So that's where regulation can push and make sure that a product can get off. And if we look at the numbers, I think before the revision started, there were 28 LTIFs. And now we have 233 LTIF, of which 137 are in Luxembourg. So sometimes regulation can help and can push things forward. But now we can talk about another piece of regulation, which is IFMD. We are in the midst of implementing IFMD2, so that is also version 2 of IFMD. And in your area, definitely there will be new rules for loan originating funds. So how do you see these new rules?
The new rules are
opportunity or threat?
Oh, they're a given, right? One of the regulations that are coming our way is, for example, retaining part of the loans that we originate. So skin in the game, as it's called. Well, our basic premise is that we want at least 35% of any loan that we originate, just to have a blocking minority should there be any restructuring or requirements to be more active with the borrower at a later date. So we would prefer to be the sole lender, to have complete control over the asset that we've created for our investors. So in that sense, the loan origination limit of 5% has almost no impact on us, right? Then the next element of the AMFD2 regulation is on the use of leverage. Well, I've mentioned previously in this conversation that we already have leverage limits in our fund documentation. The regulations is saying, 3 times levered. Well, I barely go above double digits in, like 25, 0.25 or something like that, very small leverage, which is mainly just FX hedging. So leverage is not really what we're offering our customers. We offer them a stable fixed income product that doesn't need to be levered, right? And so that regulatory hurdle of 3 times is easily matched, not a problem.
That's good to hear, Doug, because I've been hearing some in the market who say these new leverage rules are an issue and are going to maybe coming from an unregulated product to a more regulated product be an issue. But let's see how that turns out. I think this brings us already at the end of our short interview, and definitely what we could see is that private assets is on the rise. And so I think you should stay tuned on this. And now I'm going to hand over to Matthias for closing remarks. Matthias, over to you.
Thank you, Corinne. Ladies and gentlemen, we have now reached the end of today's program. From opportunities in thematic ETFs and equity markets to the growing role that private debt and real assets have in portfolio compositions, today's discussion have highlighted how investors navigate a changing landscape. I would like to thank you all for joining us today, as well as to our sponsors and speakers for their generous support. We will be back in December for LFF's inaugural Outlook on 2026 event. Until then, stay tuned and thank you again for being with us today.